Thank you, Dave, and I apologize to everyone for my voice. I had some vocal fold injections, which makes me sound like the Godfather, but I'm really not. I feel much better than I sound. Thanks for being here. Since I made my first trade in 1967, about 50 some years ago, I've always loved fast cars. I have a lot of fast cars. I won't let anybody drive my fast cars unless they know how to do it, because they could get killed. Trading S&P futures in the day session, day trading, is like driving a fast car. It seems that everybody and their brother wants to day trade the S&P. Why? It's got a lot of sex appeal. It makes a lot of big moves. It has great profit potential, but it also has great risk. And the problem is this. If you're day trading S&P using common thinking, you're competing against the biggest, the best, the fastest trading machines in the world, and you will lose money. Trying to day trade S&P with a small stop is a guaranteed losing proposition. It can't be done effectively unless you're a machine. I've got nothing wrong with trading the S&P. I think it's great if you know how to do it. But let's face it, folks, in 45 minutes at a free webinar, you're not going to learn how to do that. The good things about getting something for free is that it's free. The bad thing about giving away something for free is that you will usually not use it, you will usually not value it, and you usually not appreciate it or follow through. But today, I'm going to give you something, unless you already know it, which is totally free. And I will do my absolute best to give you a specific, complete demonstration of what I'm talking about without any ifs, ands, or buts, any interpretation, no looks like, no kinda, no tweaking, none of that stuff. A complete, solid method, and I hope that you follow through and use it consistently. So let's begin. So what I have for you today is not perfect. We all make mistakes. Stupid mistakes are happen all the time. The best thing we can do is keep it at a minimum. If you're consistent and you begin with enough money, it will work for you. But if you have too much information and too much micromanagement, too much interpretation, too many inputs, it's not going to work. Also, I caution you not to mix time frames. Don't look at a daily chart to try and figure out what's going to happen intraday. Find your place and trade within that place. I'm going to show you how. Remember, it's better to do a few things really well than many things poorly. And last but not least, you don't know how deep a hole is until you stand in it. And what the hell does that mean? Real simple. Don't fancy yourself to be a great day trader in S&P or any other market for that matter until you know exactly what it's all about. By which I mean, know your risk. Don't just think you know your risk. Know your risk to the exact dollar amount and know that that is the probable amount you're going to lose or more. So never guess at a stop. I'm going to show you how to do that. So today I'm going to show you divergence. The single best, most powerful indicator in the world that has made me a lot of money and continues to make me money. If you already know the method, this will be a great refresher for you. If you don't know the method, I'm going to teach you one of the ways in which the language of the market communicates with us. In order to trade successfully, you need to know the language of the market. The language of the market, in my humble opinion, is not Fibonacci, not Elliott wave, not candles. It's really simple. When you look at my charts, you're going to see something very simple. Just two things, price and momentum. And it's always going to be momentum 28. If you don't know what momentum is, look it up. It's all over the internet. The formula is there. It's really simple. It's not a moving average. It's very, very simple to understand. It's so easy, even a computer can figure it out. So what I'm going to show you today is 100% rule-based. It's based on a model. I'll show you the model. I will show you 3 profit targets, profit maximizing strategy. There will be no analysis, no looks like, no interpretation, no guesswork. We will know our stops and our targets in advance. We can use it in all time frames, but listen to this. It's a goddamn cookbook. A, B, C, D, and E. But first, let's talk about what divergence is. Divergence is the relationship between an indicator and price. Momentum, MACD, are 2 indicators that measure the direction of the market and tell you when price and the indicator are diverging. Think about this. Most major up moves begin with down moves. Most major down moves begin from up moves. We have 2 conditions in the market, normal and abnormal. Normal behavior in the market teaches me nothing. It doesn't tell me that something might happen. Abnormal behavior is what I'm interested in. I want to monitor the markets very closely with specific indicators to let me know when things are abnormal. Momentum divergence is a way to know that things are abnormal. So, most timing triggers don't work because they're not specific. They're based on mythology. Patterns, predictions, and profits are very important because the markets are all about patterns. Momentum divergence is one such pattern. We have to take that pattern and fit it into a trading model, which consists of 3 aspects: setup, trigger, and follow through. And this trading model, setup, trigger, follow through, is important to you no matter what methodology you use. Every trade must have a setup. A setup is a pattern. After you have a pattern that's repeated itself many times, that pattern has to trigger in this particular instance. So you see a pattern, and you watch for a trigger. The trigger is a specific configuration. The third step in the process is follow through. Follow through consists of 2 things: when to take your losses and when to take your profits. Remember that I have tutored and taught thousands of traders all over the world, in every corner of the world. People call me and they say, "Jake, I'm a really good trader. You want to know why?" I say, "Why are you a good trader, Joe?" And they say, "Because I know when to take my losses." That's totally ridiculous. To be a good trader, that's only part of the equation. You need to know what to do with your profits. The sad truth and reality is this: most traders take small profits and big losses. It's always been that way, and it will evermore be that way because most people don't know how to maximize profits. So, 3 steps to the formula: setup, trigger, and follow through. I'm going to show you how momentum divergence trades set up with a specific cookbook approach. I will assure you that if you follow the cookbook approach and the rules I'm going to give you today, you will always be able to spot divergence, and most of the time you will see that divergence materialize into a winning trade that reaches targets 1, 2, and 3. Let me show you what I mean. Now, you can go back and look at these rules when you get the recording. And so what I'm going to do is show you the language, and then we're going to look at specific examples that are happening right now and that have happened recently, and I'm going to show you how to do this process. I will not have time for questions today. And by the way, I'm not going to try and sell you anything. I will give you an opportunity to become one of my students. I'm starting a new series of classes this Sunday. You can send for information on it with the link that Dave's going to show you. And that's all the sales I'm going to give you right now. So we will use momentum 28 or MACD 9 and 18. What does that mean? Momentum 28. If you have trading software, find your momentum indicator and make it 28 of the close, which means momentum is being calculated on the last 28 prices. Or you can use MACD 9 and 18. 9 for the fast, 18 for the slow. If anyone has any questions about any of these, send me an email. I'll be glad to answer them. Period. Look at the last 60 price bars, 60 price bars, by which I mean 3 months, 20 trading days in each month on a daily chart. If you're using weekly charts, 60 weeks. If you're using intraday charts, 15 minutes in length, 60 price bars of 15 minutes each. Why 60? Because everything I'm going to show you today has been traded and tested empirically for many years. 60 is the number that gives the best results. Bullish divergence. When you make a new high in price for the last 60 bars and no new high in momentum. And don't worry, I'm going to show you specifically what I mean. You're going to see so many examples today. If it's not clear to you today, either I'm a bad teacher or you've got a learning disability. And I'm a pretty good teacher. So, bearish divergence. You make a new low in price for the last 60 bars with no new low in momentum. I will show you specifically what I mean. If you want more information, go to my website, jbernstein.com, and take a look at the Power Momentum Manual. We're going to set up 4 points, A, B, C, and D. We're going to look at a trigger point, E, and we're going to look at normal versus abnormal behavior. Let me give you an example. Here's a chart. Now, I'm going to go slow, nice and slow, so please pay attention. I want you to get this. I want you to see how amazing it is and how simple it is. And remember, no moving averages, no Elliott wave, no Fibonacci, no Gann, no magic numbers, nothing like that. This is a normal price momentum relationship. Let me explain it to you. Let me get my pointer. Price going down, momentum going down. Price going up, momentum going up. Price coming down, momentum coming down. Price going up, momentum going up, price going down, momentum going down. A completely normal relationship here. Momentum and price moving together. This does not tell me anything about the market. What does? What tells me something about the market and its potential, its future, is the relationship between price and momentum when it becomes abnormal. Let me show you what I mean. Same chart, but we're going a little bit farther. This over here is where we left off with the last chart. In other words, right over here is the end of the chart. And this is the continuation of the chart. This happens to be a crude oil chart. It doesn't matter what the chart is, but I want you to look at it and pay close attention, please. Everything is normal. Price and momentum going down together. Everything here, normal price and momentum going up together. However, something happens right here. I'm going to stop for a minute and give you a chance to look at it. If I was teaching a normal class here where you could respond to me, or if I was teaching a mentoring class, I would ask a question and a volunteer. Let's just imagine that I'm asking you a question and a volunteer, and Joe volunteers and says, I see the difference. Look what happened. Right over here, let me turn on my pointer again. Right over here, price and momentum both were low. But then price started to go down, continued to go down, but momentum continued to go up. Clearly a point of divergence. And what happened after that point of divergence was a huge rally in the price of crude oil worth thousands of dollars over a period of about a few weeks to a month. So the concept is really simple. What can we do with that concept? How can we put that concept into operational, rule-based terms instead of saying, looks like we've got divergence? That's not good enough for me. I want specifics. So let me go to the next chart. This chart again shows the difference. Right over here in the shaded area, we've got divergence, call it bullish divergence, normal, and normal. We have a specific rule for finding these. In fact, This is totally rule-based, and it's so easy. Even a computer can do it. In fact, later I'll show you how the computer finds these for us, so we don't even have to look for them. The question is, what is the process? Let's go to the chart. Again, same chart. The only thing I've done is I've removed all the arrows. I'm going to give you the rule. Pay attention, please. Find the lowest intraday low during the last 60 days. This line over here, which I will mark with my pointer, is a 60 bar line from here. So, I think we all agree without interpretation, this right over here is the lowest intraday low. The next question to ask is the lowest intraday low also the lowest momentum? The answer is no. So we have marked points A and point B. We know with a fair degree of accuracy that if, and repeat, if there is a trigger, we will get a move to the upside. But I need to take the next step. This is point A, this is point B. Next step in the cookbook. Find the lowest momentum previous to point B. Agreed, that is right over there. No interpretation, absolutely clear. If you don't agree with me, there's something wrong with you, or your chart, or your screen, or something. So we have 3 points now. Lowest low in price, A. B, the momentum that corresponds exactly to that lowest intraday low. C, the lowest momentum previous to B. And D, the price that correlates to that momentum low. A, B, C, and D. Now I have my 4 points. That is my setup. If you've been paying attention, you know the next step in the process is a trigger. I need a trigger, something to get me into this trade, because if there's no trigger, there's no trade. The trigger, by definition, the trigger is momentum going above the highest momentum between these 2 points, and that would be right here. I'm going to draw this in for you on a live chart momentarily. The bottom line is very simple. Once I have my momentum divergence set up, I'm waiting for momentum to end any day or any bar above this number. And that red line is a number. I know what that number is. And if your momentum formula is correct, you will have the same number as I do. Very simple. And when that happens, we become buyers. So let me show you something else. Let me go to my live screen. And Dave, if you would tell me if you can see my live screen. Are you there, Dave?
What was your question, Jake?
Can you see my live screen?
I can see a screen, yeah.
Okay, that's all I need to know. Thank you very much. Okay, we're back again. So here's that same chart we were looking at. I'm going to do some very simple stuff on this chart, which you can do on your chart. Anybody can do this. There's no big secret. I'm going to find the lowest price right over here. I'm going to mark that lowest price with a vertical line like this. Those are my points A, B. I'm going to find the lowest momentum previous to that and mark that with a line as well, like so. One moment, please. There's my divergence. Clear, absolutely objective. No looks like no kinda. The next thing I need is a trigger. Definition of the trigger. Within these two lines, A, B, C, D, inclusive, I need to find the highest momentum. That momentum is a number. The number here is minus 10.52. The number here is minus 10.10. The highest number is minus 10.10. If momentum ends any day, and repeat, ends, not during the day, but ends any day, greater than that number, I am in. So let's mark that number here. And by the way, as I said before, this is so simple, even a computer can do it. And we're going to go like this right over here and drag it across and find our trigger. Now, please pay attention. In order for the momentum setup to be valid, I need to have 6 bars inclusive between these two vertical lines. 6 or more. It's very simple to understand, and as I said, it's so simple even a computer can be programmed to find these. What's next? As soon as I close above that number, which for all intents and purposes is right over here, I'm going to mark that line like so. One moment, please. I have a trigger. My trigger occurs at the end of the bar right over here. If you've been paying attention, you know what we've got. Buy setup, buy trigger. Step number 3, follow through. Follow through consists of two parts, profit target and stop loss. We will objectively determine the profit target. Very simple. I get what's called my dollar difference tool in Trade Navigator, and I measure from the highest intraday high. I'm going to do that measurement for you right now, right over here, to the lowest intraday low during the period of divergence. That's going to go from here approximately to here. Now you might say, well, that's $11,000 in futures. That's too much for me. No problem. If it's too much for you, and the mini is too much for you, then you don't do the trade or you find an alternative. There are many ETFs that mimic crude oil prices, so you can find what's right for you in terms of risk. But now, let's ask the question. Target number 1. Target number 1, at which I take 1/3 of the money off the table, is 50% of this $11,710 range. For the sake of argument, let's call it $5,500 as measured from the point of entry. That would be right over here. So let me measure it. In fact, let's measure the entire move because this chart is up to date. So let's go from here, the dollar difference tool. One moment, please. Oh, such pressure, pressure, pressure. From here to the high of the move. Roughly speaking, $10,000 move. Question, did we hit 50% of this range? Yes. In fact, we are approaching the full profit target. In terms of the day-to-day money management, I'll give you the rules and then I can expand on them for you if you want. We have what? Target number 1 hit, take 1/3 of the money off the table, place a stop at break even, which is right over here. Target number 2, if it's hit, place a trailing stop, which I discuss in my mentoring classes and in some of my written material. That's all there is to it. Very simple, very specific, very clear. But remember, your initial risk is also this amount. The good news is that they hit their first profit target very quickly and you're out of danger because you have your stop at break even. Very simple, very specific. And as I said before, you know your risk before you get into the trade. Now let me show you something. Here's another one. Here's a stock. That stock, Snap, just announced earnings about half an hour ago. It is now trading all the way up here at approximately $8.50 a share. The question is, what preceded this move? Again, we're going to go to the lousy cookbook and not think about Elliott wave, Gann, Fibonacci, Drummond geometry, trend line, support, resistance, or any of that stuff. We're just going to use the cookbook. Easy. Find the lowest intraday low in price. Right over here. Market. Find the lowest momentum previous to that. But before you do that, ask the question, was that also the lowest momentum? The answer is no, we've got divergence. What kind of divergence? Bullish divergence. Go to your left and mark the previous momentum low right over here. And that's right over here. Next step, find the highest momentum between these two lines inclusive. That would be right over here. Let's mark it. Get the dollar difference tool, like so. And I realize I'm throwing a whole lot of stuff at you, but good news is Dave will send you the recording and you can play it back. There's wrong tool. Just one moment, please. Let me get the right tool. It's very difficult to operate under this pressure. And it's probably going to be this one. Let's look at it. Minus 32. Minus 38. Minus 30. It's this one right over here. Bingo, right over there. Did we pick the exact bottom? No. Sometimes we will pick within a day of the low or the high, but that's okay. I'm not interested in picking highs or lows or being a hero. I'm just interested in making money. So what did I know at that time? I knew the setup, the trigger. I knew the follow through. Let's do the follow through. Highest high to lowest low. Again, notice the rules don't change. Get my dollar difference tool. Find the highest intraday high during the period of divergence. That was right over here. And drag it down to the low, which was right over here. And that would be right over here. So you can say, I'm not going to risk $2.62 on a $5 stock. Guess what? You don't have to. You don't have to trade 100 shares or 1,000 shares or 300 shares. You can trade 50 shares. You can trade 20 shares, whatever floats your boat within the risk parameters that you have. But that's not what I'm interested in. I'm interested in reaching my first target. The first target is $1.31. This is the hardest part of the whole process, dividing $1.31. Let's go from the trigger. And by the way, let's find out if this was the trigger right over here. One moment, please. The trigger point was minus 0.3. And this over here was minus 0.26. I stand corrected. Sorry about that, ladies and gentlemen. Let me put it back to where it goes. That trigger point was right over here. Let me move that over. Okay, that's our trigger. Now the question is, are we out of danger? Have we moved to $1.32? Well, based on where the stock is trading at approximately right now, let's find out. Get the dollar difference tool, like so. And drag it from here to here. And what has happened? So there it is. Unless things change drastically overnight, we have reached targets 1 and targets 2 and would be out of 2/3 of our position, trailing a stop on the last 1/3. Piece of cake. Not perfect, but I want you to recognize and appreciate the difference between what I do and what so many other people do. There is no guesswork here. I'm not going to come to you and say, you interpreted it the wrong way. You're not looking at it the right way. I will either say you are right or you're wrong. We agree or we disagree, but it will be objective and there will always be an answer to the question, what are the points A, B, C, D, and E? Okay, so let's do this. Let's look at another one. Here's another one. General Electric, the stock that everybody and their brother loves to hate. Now that you've learned the language of the market based on divergence, you can see it before I even put it in, can't you? You can see how at some point, as prices were moving down, there was a divergence. Prices continued down, but momentum started to go up. Let's do the same rule. A and B. I'm asking you the same question all the time. And by the way, this is not perfect. I don't present this to you as perfect. I don't present this to you as saying we will never get stopped out. We will be wrong, but we'll be right a lot more than we're wrong. Points A and B. Next step, again, piece of cake. Find the lowest momentum between the two. That would be right over here. I'm going to mark that with my handy dandy little line. That's our momentum divergence. Next point, trigger. Remember, the trigger point is the highest momentum 28 between those two vertical lines inclusive, which means that this point right over here is point AB as well as point E, the trigger. So as soon as we go above that, we're buyers. That number, reading off the top left of the screen, was minus 3.42. The very next day, we were minus 3.39. So guess what? It triggered right over here, one day after the low. How good is that? Okay, next step. Again, always the same stuff. Boring, no sex appeal, but pretty damn cool. Let's do this. Get the dollar difference tool, dude. Piece of cake. Right over here. And drag it from the highest intraday high to the lowest intraday low during the period of divergence. That would be approximately here. And forgive me if I'm off by a few pennies. A $1.60 move is what we're looking for. Since the trigger point, how much has it moved? Well, let's do that. Again, we've got computers. Why not use them? Again, let's drag it from here to here. And I don't expect you to take anything I'm telling you on faith. I want you to see it yourself. Try it. Don't jump into this until you understand it thoroughly. Okie doke. Let's go all the way to here, which is the high of the move. So here's the cool thing, ladies and gentlemen. We were only expecting a $1.60. We got $4.07. I think that's pretty damn cool. Now, we've looked at some bullish divergence. Let's look at one more and show you the bearish side. Apple, the stock that everybody else loved to hate as well. But now you can see it, can't you? I don't even have to show it to you. But if you can't see it, take your time and study it. Again, the same damn thing. AB, right here. CD. Count the number of days. 1, 2, 3, 4, 5, 6, 7, 8. That's enough. Trigger point right over here. Penetrated right over here. Approximately a couple of days from the low. How good is that? Let's move it over one day. Just one moment, please. Dave, you got to give me more time next time. I'm happy for the 45 minutes, but I need more time. So that's that. Very small profit target. How small is small? Let me show you. I'm going to go like right over here. And then we'll just have enough time to do one bearish divergence. And then we'll call it a day. But there's more graphics on this slide presentation. So here you go. And I'm going to measure it from here to here. Well, that's not too shabby, considering we expected $5 or $6 and got a whole lot more, I guarantee you that, or $16. So that's that. Let me show you a top. Great stock, great car. I own one. It's pretty damn fast. What about bearish divergence? Tesla. Opposite situation. Find the highest time price right over here. Was that the highest momentum? No. Highest momentum was right over here. Opposite situation. New high in price without a new high in momentum. Find the lowest momentum between the two. Let's get that right over here. Stick it right over here. Drag it down a little bit so we get the right number. Close enough. I think you get the picture. Triggered before the big break to the downside. So we've got just a few minutes left. I can show you many, many examples. The question is, how do we find them? Let me go back to the presentation. One moment, please. Here we go. Take your time and go through the slides. You're going to see numerous examples of the same thing. In fact, I've got one computer program to do it for me automatically. How do we find them? Well, fortunately, I work with Chris Moody, who is a brilliant trader and a fabulous coder, who's coded all of this for me in TradeStation and Trade Navigator, so that at the end of the day, we have a list of stocks that we're looking at a radar screen or futures that we're looking at a radar screen that will tell us what's being set up and what the specific setup is. So there's more information here which you can look at with more examples. If you have questions, you can reach me at trade-futures.com. If you want to learn how to do this and a whole lot more, even better, become one of my students in my 90 Days to Trading Mastery class, which begins this Sunday at 4 p.m. California time. Dave, do you have the link? Oh, there it is. Thanks a lot. That will explain the whole program to you. It ain't cheap, but you will get what you paid for and a whole lot more. Dave, thank you very much for the opportunity. Sorry about my raspy voice. I hope I've been able to teach you guys something today, and I hope you appreciate it.